Barry, what's the biggest takeaway for you from the Fed as it relates to the market's direction?
There's two issues. One is, so my market on whether they ease any further this year is zero bid at 2, right? And the idea is if we get a trade deal, there's absolutely no reason for them to ease further. They won't need to. They wouldn't have been easing in the first place had we not impaired business confidence and capital spending so much with trade policy. 2 is if the deal falls apart, in which case 2 isn't going to be enough and market's going to struggle mightily. So that's sort of issue number 1. Issue number 2 is Rick commented right before the close about the dollar being roughly flat this week. That is true, except that the Brazilian real's down about 2.5%. South African rand is down about 1.5%. And so all these currencies were down. Now, yesterday afternoon, you guys had a conversation with McCulley and Zervos. And, Zervos came out on the side of there is a element.
Loyal viewer, I like this.
Yeah, that's right. So there's an element. I was glued to TV yesterday. It was a big TV day for me. But anyway,
always closing bell.
Right. Zervos made the point that there is an element of the dollar shortage call embedded in this repo crisis. And so what the Fed is going to find themselves having to do by October, people will consider it restarting QE, but they're going to have to start expanding the balance sheet by providing abundant liquidity in the front end. That should start alleviating some of this pressure, upward pressure on the dollar. But that kind of hangs out there as a potential curve steepener, hit to gold, reversal in the dollar dynamic as well. And I think that's a little bit underappreciated because if you look at the 24 hours since the Fed, to me, that's the one thing that stands out is that you still have these, the high-yielding emerging market currencies that are under pressure.
Stephanie, in terms of the Fed itself, is it at least now not the key issue that could either support or derail the markets, that you can focus on other issues like trade?
Well, no, I think the Fed is always going to be in light, but trade obviously now takes center stage because you've got the talks starting next week, and we'll get bits and pieces out in terms of how it's going, and so that's what we're really going to trade on. But no, the Fed is really important. I think every economic data point is going to be scrutinized because the data in the States is actually a little bit better. Inflation is actually creeping up just a little bit, and I think they're getting themselves in a bit of a box. So that's why trade is going to be a little bit more important in the near term, but the Fed obviously in the long term. And then, of course, we have earnings just in a couple of weeks, and we're going to hear from a lot of companies. And so far, on the industrial side and the metal side, it doesn't look so good.
I think the key is the U.S. consumer. And if you look at consumer discretionary, retail really underperformed today.
Yeah.
It's a place you look because that has been the backbone of the strength in the U.S. economy. It's what sets the U.S. apart from the global economy.
Yes.
It's what makes the Fed's job particularly difficult.
It's the key to the economy. It's a little bit less the key to the stock market on a shorter-term basis just because it's not pure consumer spend that we're capitalizing in the S&P 500. But yeah, in terms of what the Fed decides to do, interestingly, I think they'd be okay with the consumer being in good shape, the labor market not being anything to worry about. And if the global issues give us a reason to ease because the data hasn't been that great, they'll go ahead and do it. So that's a kind of win two ways scenario where the consumer's fine and maybe you still get a break down the road.
I think that the issue, though, with the consumer is consumption collapsed during the QT-related crash late last year, bottomed in February. By May, it was growing. Retail sales were growing 9.5% on a year-on-year basis. They were at a similarly strong level in July because of Prime Day. The year-on-year number's back to 4.5%. So my argument is
housing is coming back.
Well, housing's coming back, but consumption is settling back into its trend of about 2.75%. If there is a further hit to business confidence and the labor market weakens, then this whole narrative that the consumer's fine and investment's weak could deteriorate into, well, wait, the labor market's weak and all too, which is why it's so critical to stabilize business confidence and get a deal in the next month or two, because otherwise that whole, deceleration, it's not like consumption is good right now, but it
not only is consumption good, but the confidence is still quite strong. It's been resilient, actually. So, I totally agree with you. If it collapses, if business confidence collapses, that's not a good thing. But both have actually stayed fairly elevated in the face of a lot of issues out there.